So let's say, for example, you're working with an expansion structure. You get your point 1 and point 2, and you're expecting a clean third touch to complete the structure. But that third touch just doesn't happen. Instead, price reacts early, and that early rejection becomes your override zone. Now, this override is usually found at a double top or double bottom, depending on whether you're selling or buying. In this case, let's say we're looking for a sell, and we get a double top formation instead of that expected third touch. This is where the insurance entry comes into play. Rather than forcing a trade or taking an entry without confirmation, you wait. The override tells you, okay, we might not be going for the third touch. The rejection is already happening here. But you're not just selling off that first rejection. You're smarter than that. You're waiting for confirmation. The insurance entry logic. So imagine you're on the 1-hour time frame. You were waiting for that third touch. It never comes. Price rejects early off the override and then forms a continuation structure, maybe a flag, a wedge, or a mini consolidation. That right there, that continuation after the rejection, becomes your insurance entry. The idea behind the insurance entry is this. You're entering in an area that's less confirmed, but you're not going in blindly. You're waiting for the first continuation after the initial rejection. That continuation adds the confirmation you need to execute the trade with confidence. Now, you can approach the insurance entry in 2 ways. Number 1, risk entry. You take the trade within the continuation structure, ideally from the top of that range. Your stop is placed just above the structure, and you target the low, or the next key level in the trend direction.